Hello and welcome to this special report here at XM.com. Everyone is focusing on the risk of default, but there might be other more realistic risks surrounding the debt ceiling saga. I'm Maria Bachordes, and joining me to discuss all this is Senior Investment Analyst Marios Hadjikyriacos. So Marios, there's been quite a bit of political theater over the past few weeks as U.S. lawmakers try to reach a deal on the debt ceiling. Investors have been worried about the risks of a default, but is this what they should be focusing on? If not, what's the true risk?
Hello, Maria. Well, I think we all know that, you're absolutely right. It's mostly political theater. It's a political game of chicken in the sense that we all know they're going to find a compromise at some point. Nobody wants the US government to default. That would severely damage the nation's credibility. It would raise borrowing costs. It would just make things worse for both parties. So a deal is coming. The question is, how long does it take before we get there? And does the government shut down in the meantime? Now, what I think is a much more realistic risk, well, it has to do with liquidity, really. So let me start out by saying that liquidity is basically the lifeblood of the modern financial system. It's the oxygen that keeps, let's say, global markets alive. So after we find a debt ceiling deal, what's likely to happen, almost certainly, is that the US Treasury is going to have to replenish its cash balance. As we speak, the Treasury is sitting on about 60 billion in day-to-day spending money, let's say. Now, according to the Treasury's own estimates, they want that number to go up to 550 billion at the end of this quarter. So that means that after we find a debt ceiling deal, the Treasury is going to flood the system with newly issued bonds. They are going to ramp up borrowing, and they're going to do that to raise their cash levels. So in essence, what I'm getting to is the Treasury is going to dump more than $500 billion worth of bonds into the system, which investors will need to absorb. Now, when you do that, when you put that many bonds into the financial system, it has similar effects to quantitative tightening. It reduces bank reserves, it might reduce liquidity in the overall system, and therefore, I think it's likely to be a detrimental effect for financial markets. Think of the last 10 years with quantitative easing, right? The markets were doing very well. Well, suddenly when we do quantitative tightening and we put that process into reverse, the markets are not doing so well. And I think this quantitative tightening process is about to be put on steroids in a sense because of what the Treasury is about to do.
Okay, so keeping all this in mind, what are the potential effects in the markets?
Well, when you essentially drain liquidity out of the financial system, what you would expect to see is riskier assets, that is, stocks, but especially tech stocks or highly speculative stocks, unprofitable companies and so on. Those type of assets and even riskier assets like cryptocurrencies, those are likely to do badly. So it's very useful to think about the recent moves we've seen in the markets through the lens of liquidity. The liquidity essentially bottomed back in October, right around when the stock market bottomed. Not because of anything US specific, but rather because of what the Bank of Japan and the People's Bank of China were doing. They started injecting liquidity into their own systems right around October, and that helped foreign markets, even US markets, to rebound, and we've been rallying ever since. Well, if that process goes into reverse, and suddenly the Treasury is draining liquidity out of the market, and in fact we've seen the Bank of Japan and the People's Bank of China also reducing their own liquidity, that would spell bad news for riskier assets. I think it would undermine the latest rallies we've seen in tech stocks, in crypto, And by the same token, it might be beneficial for the US dollar because, of course, the US dollar tends to perform well when liquidity dries up and when the markets sell off. So, in a nutshell, Maria, even if we see a government shutdown next month, I think we're likely to see a deal eventually. The important thing is what happens afterwards. Once the Treasury unleashes a tsunami of bond issuance, that might amplify the effects of quantitative tightening, drain liquidity out of the markets, and therefore it might be a tough summer for riskier assets, stocks, and crypto.
Marius, thanks so much. And thanks for joining us for this special report here at XM.com.